When historians talk about the devastating financial crash of 1720, the story usually centers on Exchange Alley in London. The narrative is almost always framed as a sudden, inexplicable madness that gripped the entire British public. The evidence for this mass delusion usually points to the thousands of ruined speculators, including Sir Isaac Newton, who lost £20,000 in the panic. The surviving satirical prints of the era show a public entirely divorced from logic, gambling away their estates in the streets. But in a market crash, capital does not actually vanish into thin air. It moves. It flows from the accounts of uninformed participants directly into the hands of a highly informed strategic minority. The South Sea Bubble was a highly engineered wealth extraction machine, built with precise legal mechanics to solve a very specific problem: the crushing national debt of Great Britain. By the early 1700s, decades of constant warfare across Europe had left the British state drowning in a fragmented £50 million web of unfunded military debentures and annuities. To clean up the balance sheet, politicians passed a 1711 bill to create the South Sea Company. This public-private partnership was designed to absorb those scattered, discounted government liabilities and convert them into unified company shares. To convince citizens to trade in their government bonds for company stock, the directors needed a compelling cover story. They secured the Asiento, a monopoly contract allowing them to supply enslaved Africans to the Spanish colonies in the Americas. The British public envisioned massive fleets returning with endless colonial gold. In reality, Spain maintained draconian control over the Asiento. They heavily taxed the slave quotas and restricted the British to sending exactly one general trading ship to the region per year. The South Sea Company routinely lost money on these actual voyages. Its sole functioning business was the management and laundering of state liabilities. In 1720, the company reached an agreement with Parliament to absorb another £30 million of unconsolidated state debt, but the legislation authorizing this maneuver contained a massive exploitable flaw. It never set a capped conversion ratio. There was no fixed share price at which the debt had to be exchanged. Look at how this math works on a structural level. If a company takes on £30 million of debt and its stock trades at £100 a share, it has to issue 300,000 shares to the debt holders to satisfy the swap. But if they pump the stock price up to £1,000 a share, they only need to issue 30,000 shares. The directors could then take the hundreds of thousands of authorized surplus shares and sell them directly to the open market. To drive the stock price up and generate that surplus, the directors flooded London with artificial liquidity. They introduced new equity tranches called money subscriptions, allowing speculators to buy these extra shares with only a 10% down payment. Then they initiated an endogenous credit loop. The company began loaning cash directly to its existing shareholders to buy even more stock, using their currently overvalued shares as collateral. People bought shares on margin, the stock price rose, their collateral value increased, and they borrowed more cash against it. By tying the government debt swap to an uncapped share price and pumping the market with highly leveraged credit, the directors turned a state financial tool into a self-sustaining Ponzi structure. This artificial loop trapped thousands of retail investors who bought into the hype at the absolute peak. Even Sir Isaac Newton, who initially cashed out early with a reasonable profit, succumbed to the immense social pressure, jumped back in at the top, and wiped out his life savings. But the institutional insiders navigated the market differently. The partners at Horace Bank understood the macroeconomic distortions at play. Knowing the asset was mathematically detached from reality, they deliberately executed a strategy of momentum trading. By timing the artificial liquidity flows, they extracted over £28,000 in net profit. Sarah Churchill, the Duchess of Marlborough, analyzed the company's non-existent commercial cash flow and concluded the valuation was doomed. Exercising strict discipline, she liquidated her family's entire portfolio months before the crash, secured a massive profit, and immediately parked the cash in hard assets like real estate. The prominent bookseller Thomas Guy systematically scaled out of his massive holdings directly into the rising market peak. He secured a fortune so colossal that it entirely funded the construction of a major medical facility in London, an institution that stands to this day. Survival in the 1720 market did not require raw intelligence. It required asymmetric access to information and strict unemotional risk management. By the summer of 1720, hundreds of smaller, bizarre startup companies had floated shares, draining vital speculative capital away from South Sea stock. To maintain their monopoly on investor cash, the South Sea directors successfully lobbied Parliament to aggressively enforce the new Bubble Act, legally criminalizing these competing ventures. The decision backfired instantly. When the government shut down the smaller unauthorized companies, their shares went to zero. Retail investors who had borrowed heavily against their portfolios suddenly faced immediate systemic margin calls. To raise the cash needed to cover those debts, investors were forced to liquidate their most valuable and liquid asset, South Sea stock. The sudden avalanche of sell orders shattered the upward momentum, and the share price went into a vertical freefall. With the banking sector facing collapse and the public demanding executions, the Chancellor of the Exchequer, Robert Walpole, orchestrated a brutal political triage. He confiscated £2 million from the private estates of the company's directors to offer partial restitution, while simultaneously suppressing parliamentary evidence to shield the king and his top ministers from impeachment. To prevent a sovereign default, Walpole stabilized the underlying state liabilities by transferring portions of the toxic South Sea debt to the stable balance sheets of the Bank of England. He then established a sinking fund, segregating specific tax revenues strictly to pay down the principal over time. The trauma of the crash resulted in a severe regulatory lockdown. Parliament kept the Bubble Act firmly on the books for over a century, requiring exceedingly rare and expensive royal charters to form any new joint stock company. The South Sea Company did manage to consolidate the national debt, but the resulting legislative deep freeze completely choked off public equity financing in Great Britain, starving generations of entrepreneurs of capital.
Thanks for watching. Please subscribe to know and learn for the historic events of the time.